There are two rules for investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. These are the words of Warren Buffett, the most successful investor in human history. And for decades, the world has treated these two rules as a clever piece of folk wisdom, a charming aphorism from a grandfatherly billionaire. But they are not an aphorism. They are the inviolable foundation of a system of thought so powerful it has generated hundreds of billions of dollars in wealth. A system so robust it has navigated the most terrifying market crashes of the last century without ever suffering a catastrophic, permanent loss. And the entire architecture of this system, the engine that powers both rules, is built upon three simple words: margin of safety. This is not a stock tip. This is not a get-rich-quick scheme. This is the master key. It is the single most important investment principle you will ever learn, because it is the only principle that truly separates investing from gambling. It is the intellectual and emotional firewall that stands between you and the madness of crowds, the panic of the market crash, and the euphoria of the speculative bubble. It is a concept conceived by Buffett's great mentor, the father of value investing, Benjamin Graham, and it is the final promise an investor can make to themselves, the promise that they will never be forced to lose. In the next hour, we are not going to simply define this term. We are going to deconstruct it, atom by atom. We will journey through the specific deals, the psychological biases, and the hard-nosed financial calculations that make the margin of safety the cornerstone of all intelligent investing. We will build from the ground up the mental framework that allows you to look at the chaos of the stock market and see not danger but opportunity. You will learn not just what it is, but how to calculate it, how to demand it, and how to use it to protect your capital and grow your wealth for the long term. This is the antidote to speculation. This is the blueprint for wealth preservation. This is the core lesson from The Intelligent Investor, made plain and simple for anyone to understand, from beginners to seasoned professionals. So let us begin the journey to understanding the ultimate principle of portfolio protection and defensive investing. Let us begin our deep dive into the margin of safety. The very first step on the path of value investing is a profound philosophical shift. It's an intellectual leap that, once made, permanently alters your perception of the entire financial world. It is the realization that the price of a stock and the value of the business it represents are two completely different things. Price is what you pay, value is what you get. This distinction is the bedrock upon which the entire concept of a margin of safety is built. Without it, the words are meaningless. Price is the number you see flashing on a screen, a fleeting consensus of momentary optimism or pessimism among millions of strangers. It is driven by headlines, by algorithms, by fear, by greed. It is a manic-depressive business partner, an invention of Benjamin Graham's called Mr. Market, who shows up at your door every single day, offering to either buy your shares or sell you his, at a wildly different price each time. Some days he is euphoric, offering you a fortune for your holdings. On other days he is terrified, willing to sell you his own shares for pennies on the dollar. The 99% of market participants believe Mr. Market is a source of information. They see a price going up and believe the business must be doing well. They see a price going down and assume the business is in trouble. They let Mr. Market's mood dictate their own. The intelligent investor understands that Mr. Market is not there to provide wisdom. He is there to provide opportunity. His fleeting prices are not a verdict on value, but a potential offer to transact. Your job is to ignore his emotional outbursts and focus only on the cold, hard reality of the underlying business. This complete separation of price from value is not just an academic exercise. It is the fundamental insight that allowed a young Warren Buffett to find extraordinary bargains hidden in plain sight, opportunities that the rest of the market, fixated on price and sentiment, completely overlooked. The perfect illustration of this principle in action took place in the late 1950s, a time when Warren Buffett was running his small investment partnership out of Omaha, Nebraska. He wasn't yet the world-famous oracle. He was a meticulous, almost fanatical researcher, poring over the dense, dry pages of Moody's and Standard & Poor's manuals, searching for companies the market had misunderstood. And one day, he stumbled upon a company called the Sanborn Map Company. To the outside world, to the casual observer looking at its stock price, Sanborn was a relic, a forgotten business from a bygone era. For nearly a century, Sanborn had been the dominant force in a very specific niche, creating and selling incredibly detailed, color-coded maps of cities and towns across the United States. These weren't maps for tourists. They were essential tools for the fire insurance industry. They detailed building materials, firewalls, sprinkler systems, and the location of fire hydrants. They were, for a time, a mission-critical product. But by the 1950s, the business was in a slow, terminal decline. New methods of underwriting insurance were emerging, and the demand for these expensive, manually updated maps was dwindling. The stock price reflected this grim reality. The market looked at the declining map business and slapped a low price on the company, assuming it was on a slow road to oblivion. But Warren Buffett did not stop at the price. He did what he always did. He dug deeper. He asked the fundamental question, what does this business actually own? When he cracked open Sanborn's annual report and looked at its balance sheet, he discovered something astonishing. Over the decades of its profitable existence, Sanborn had been taking the profits from its map business and investing them in a portfolio of stocks and bonds. This wasn't just a small side account, it was a massive, diversified investment portfolio, managed with extreme conservatism. Buffett began the painstaking process of valuing this portfolio. He looked up the market price of every single stock and bond Sanborn owned. When he tallied it all up, he arrived at a staggering conclusion. In 1958, the investment portfolio alone was worth approximately $65 for every share of Sanborn Map stock outstanding. The stock market, however, in its infinite wisdom, was pricing Sanborn Map Company stock at only $45 per share. Let that sink in. The market was offering to sell you a dollar bill for 70 cents, and it was throwing in a whole, profitable, albeit declining, map business for free. The price of $45 was anchored to the story of the dying map business. The value of $65 in easily sellable securities was a mathematical fact, hiding in plain sight on the balance sheet. Buffett saw an immense gap between the emotional price and the logical value. This was a classic Benjamin Graham-style value investing opportunity. A cigar butt on the street, as they called it. One good puff left in it for free. So Buffett started buying. He quietly and patiently accumulated shares, becoming one of the company's largest shareholders. He then used his position to agitate for change, joining the board of directors. He argued, quite reasonably, that the company's management had no right to hold on to this massive, underperforming investment portfolio while the stock traded at such a steep discount to its liquid asset value. He pushed them to uncouple the investment portfolio from the map business and distribute the value back to the shareholders. After a proxy battle, he succeeded. The company agreed to use its portfolio to buy back shares from any shareholder who wanted to sell, at a price very close to the calculated intrinsic value. Buffett's partnership tendered its shares and made a roughly 50% return in a couple of years. He had done this not by predicting the future of the map industry, not by timing the stock market, but by a simple, powerful act. He had calculated the true, underlying value of the business and bought it for a price that was significantly less. The market's price was wrong. His calculation of value was right. That is the philosophical foundation of the margin of safety. The reason most people are incapable of executing a strategy like the one Buffett used with Sanborn Map is because their brains are actively working against them. The dominant cognitive bias at play is known as anchoring and adjustment. This is our tendency to rely heavily on the first piece of information offered, the anchor, when making decisions. In the stock market, the most prominent, blinking, ever-present anchor is the current price. When a stock is trading at $100, Our brain instinctively uses that $100 as the starting point for any judgment about its worth. If it drops to $80, we perceive it as cheaper. If it rises to $120, we see it as more expensive. The problem is that the initial anchor, the $100 price, may have absolutely no connection to the company's true intrinsic value. It could be worth $20, or it could be worth $200. The stock price is just a number from Mr. Market, but our brain treats it as a piece of fundamental data. Benjamin Graham's allegory of Mr. Market is a brilliant illustration of how to combat this bias. By personifying the market as a manic depressive, he gives us a mental tool to detach from the anchor. You would never let a moody, irrational business partner tell you what your farm is worth. You know what it's worth based on its crop yield, the quality of its soil, and the price of grain. You wouldn't sell it to him for a pittance on a day he's panicking, nor would you buy his half for a fortune on a day he's euphoric. You would simply use his extreme offers to your advantage. Buffett's analysis of Sanborn map was a masterclass in ignoring the anchor. The market was anchored to the story of the dying map business, setting a price of $45. Buffett threw that anchor overboard. He established his own new anchor, the calculated liquidating value of the investment portfolio, which was $65. From that point on, all his decisions were based on this logical, fact-based anchor. The market price of $45 wasn't just cheaper than it used to be. It was objectively, mathematically cheap relative to a hard floor of value. This is a complete reversal of the typical investor's thought process. They anchor to the price and adjust their story about the company to fit it. The value investor anchors to the value and waits for the price to become an opportunity. This requires conscious effort. You must fight the innate urge to treat the ticker price as meaningful information about worth. It is simply the supply and demand for shares at one particular second in time, nothing more. So how can you, as an individual investor, build this crucial mental muscle and separate price from value in your own decision-making? The key is to adopt what can be called the business owner mental model. This is a practical, step-by-step blueprint for shifting your perspective from that of a stock renter to a business owner. It's an exercise in reframing that forces you to ignore the seductive anchor of the daily stock price. Here is how it works. First, select a publicly traded company that you know and understand. It could be Apple, Coca-Cola, or a local bank whose branches you see every day. The key is familiarity with its product or service. Second, and this is the most critical step, you must mentally erase the fact that it is a publicly traded stock. Instead, imagine you have received an offer to buy the entire company, outright, with cash. The entire enterprise, its factories, its brands, its employees, its customer relationships, is for sale, and you are the potential buyer. Third, ask yourself the fundamental question: what is the absolute maximum price I would be willing to pay to own 100% of this business, with the intention of holding it for the next 10 to 20 years and enjoying all of its future profits? This question forces you to think about long-term earning power, competitive advantages, and the durability of the business model. You're not thinking about where the stock price might go next week. You're thinking about the flow of cash the business will generate for you over decades. Fourth, to aid this process, completely ignore the company's stock ticker for at least one full week. Do not look it up. Your decision must be free from the anchor of its current market price. Your focus should be on reading the company's annual reports, understanding its financial statements, and assessing its competitive landscape. Fifth, after your research, write down your number. I would be willing to pay X billion dollars for this entire business. Then, and only then, are you allowed to look up its current market capitalization. Divide your number by the number of shares outstanding to get your personal valuation on a per-share basis. Now compare your calculated value to the market's quoted price. In most cases, you will find a significant difference. This exercise, when done diligently, severs the mental connection between the frantic noise of the market and the solid reality of the business. It installs a new, logical anchor in your mind, your own calculated value. From this point forward, the daily fluctuations of the stock price are no longer a source of stress or excitement. They are merely a reference point against your own independent judgment. You have become an intelligent investor, waiting for Mr. Market to offer you a price that makes sense from the perspective of a long-term business owner. To truly appreciate the wisdom of separating price from value, we must examine the opposite approach, the path taken by the 99% of market participants. This is the path of the speculator, and it is a road paved with devastating financial losses. The speculator does not distinguish between price and value. To them, they are one and the same. Their entire philosophy is built on the idea that the price itself is the source of information. They practice what is often called the greater fool theory, the idea that you can profitably buy an overvalued asset because there will always be a greater fool willing to pay an even higher price for it. This works for a time, sometimes for a surprisingly long time, but it always ends in a catastrophic collapse. The most potent example in modern history is the dot-com bubble of the late 1990s. During this period, a speculative frenzy gripped the market. Any company with .com in its name was suddenly worth billions of dollars, regardless of its business model, its profits, or even its revenues. Companies like Pets.com, Webvan, and eToys became household names with soaring stock prices. The 99%, the speculators, saw these rising prices as confirmation of value. They thought, "This stock has gone up 500%. It must be a great company. I need to get in before it goes up another 500%. They were not buying a business. They were buying a rising number on a screen. They performed no valuation. They couldn't. These companies had no earnings to value. Their intrinsic value, based on any rational calculation of future discounted cash flows, was negligible, if not zero. The price was based purely on a narrative, a story about a new paradigm, where old metrics no longer mattered. They anchored to wildly optimistic price targets from analysts and let the herd mentality take over. Warren Buffett was famously ridiculed during this period. He was called a dinosaur, an old man who didn't understand the new technology. Berkshire Hathaway's stock underperformed the market dramatically, but Buffett was steadfastly applying the principle of separating price from value. He looked at these companies and saw no value, only price. He admitted he couldn't predict their future earnings, and therefore, he couldn't calculate an intrinsic value. With no value to anchor to, he could not invest, no matter how high the prices went. Then, in March of 2000, the bubble burst. The greater fools ran out. Prices began to fall, and the panic was swift and brutal. Companies that were worth billions one day were bankrupt the next. Pets.com, which had raised $82.5 million in an IPO, liquidated less than a year later. An entire generation of speculators who had conflated price with value were wiped out, their dreams of easy riches turned to financial ruin. They learned the hard way that a high price is not evidence of a great business, and that ultimately, price must converge with value. Ignoring this fundamental distinction is not just a strategic error. It is the single most reliable path to permanent capital loss in the stock market. The distinction between price and value isn't just a philosophical concept, it has a direct, quantifiable connection to the financial statements of a company. It manifests most clearly in the relationship between a company's market value and its book value. Market value, or market capitalization, is simple. It's the stock price multiplied by the number of shares outstanding. It's what Mr. Market says the whole company is worth on any given day. Book value, on the other hand, is an accounting concept. It is, in simple terms, the company's total assets minus its total liabilities. It represents the net worth of the company as recorded on its books. In the era of Benjamin Graham, a classic value investing strategy was to find companies trading for less than their net tangible asset value, essentially buying a business for less than the value of its physical assets if they were to be liquidated. The Sanborn map story is a perfect example of this. The book value of its investment portfolio was a hard, tangible number, and the market price was trading at a significant discount to it. Buying a stock for 2/3 of its book value provided a concrete, asset-backed margin of safety. If the business operations went to zero, you could still, in theory, liquidate the assets and get your money back, plus a profit. Today, the economy is less about physical assets and more about intangible ones like brands, patents, and network effects. So, a simple price-to-book ratio isn't the perfect tool it once was. However, the underlying principle is the same. The real financial connection is understanding the asterisked earning power value data of the business and comparing that to its market price. A company's balance sheet and income statement are the raw materials for calculating this value. You can see its historical earnings, its profit margins, and the amount of capital it needs to run its business. By analyzing these numbers, an intelligent investor can build a conservative estimate of what the business is worth, its intrinsic value. Let's imagine a solid, stable business that you calculate to have an intrinsic value of $100 per share. Its book value might be $50 per share. The market price, on a bad day, might drop to $60. The speculator sees a stock that has fallen from $80 to $60 and panics. The intelligent investor sees a business worth $100, with $50 of tangible assets behind it, being offered for sale at $60. The financial statements provide the data to build the valuation, which in turn reveals the enormous gap between price and value. This gap is your margin of safety. It's a tangible, quantifiable advantage that originates directly from a deep reading of a company's financial DNA, completely separate from the market's emotional pricing of its stock. Once we accept the fundamental truth that price and value are separate entities, the next logical step is to determine the value. This is the heart of the analytical work in value investing. The margin of safety is meaningless if you don't have a reliable estimate of worth to be safe from. You cannot know if you are buying at a discount unless you know what the item is worth at full price. This process is the calculation of a business's intrinsic value. Intrinsic value, in the words of Warren Buffett, is the discounted value of the cash that can be taken out of a business during its remaining life. It's an attempt to determine a private buyer's value, the price a rational person would pay for the entire business. This is not about predicting stock prices. It is about valuing the business itself, as if it were a private farm or apartment building. The calculation is part art, part science. It requires a deep understanding of the business, its competitive advantages, its management, and its financial health. It forces you to think like a long-term owner, not a short-term trader. The market is often swept up in narratives, in quarterly earnings, beats or misses, in stories about new technology that may or may not pan out. The calculation of intrinsic value cuts through all that noise. It focuses on the only thing that ultimately matters. How much cash will this business generate for its owners between now and Judgment Day? Mastering this skill is what gives an investor the confidence to act when others are frozen by fear, or to stand aside when others are caught in a frenzy of greed. It provides the independent benchmark against which all market prices can be judged. And no story better illustrates the power of calculating intrinsic value amidst a storm of market panic than Buffett's masterful investment in American Express during the salad oil scandal. In the early 1960s, American Express was a blue-chip stock, a pillar of the American financial establishment. Its business was built on the unimpeachable foundations of its travelers, checks, and its burgeoning credit card division. The company was the very definition of trust and financial probity, but in November of 1963, that reputation was shattered. A small, seemingly insignificant subsidiary of American Express was in the business of warehouse financing. It would lend money to companies, taking their inventory as collateral. One of its biggest clients was the Allied Crude Vegetable Oil Refining Company, run by a man named Tino DeAngelis. DeAngelis was running a massive fraud. He claimed to have vast quantities of salad oil stored in tanks in Bayonne, New Jersey, which he used as collateral for huge loans from American Express and others. The trick was simple but brilliant. The tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top for inspectors to see. When the fraud was discovered, Allied crude collapsed, owing American Express over $60 million, a colossal sum at the time. Wall Street panicked. The news hit the market like a bombshell. American Express's stock, which had been trading at over $60 a share, was cut in half, plummeting to nearly $30. The narrative was that the company's reputation was destroyed, and that the liabilities from the fraud could potentially bankrupt the entire enterprise. The fear was palpable. Investors, anchored to the terrifying headlines and the falling price, dumped the stock indiscriminately. This is where Warren Buffett's approach diverged from the crowd. He did not focus on the panic or the price. He focused on calculating the intrinsic value of the unaffected core businesses. He asked, has this scandal changed the fundamental long-term earning power of the American Express brand? To answer this, he didn't just read reports. He did on-the-ground, primary research. He went to restaurants and retail stores. He talked to merchants who accepted the American Express card. He went to banks and observed people buying travelers' checks. He was looking for evidence of brand damage. What he found was the complete opposite. He saw that customers were still using the cards and checks as much as ever. He realized that the American Express brand resided not on its balance sheet, but in the minds of its millions of loyal customers. The fraud, while serious, was contained to a peripheral, non-essential part of the business. The core franchises, the credit card and the traveler's check, were untouched and remained incredibly powerful and profitable. He then did the math. He calculated the worst-case scenario for the salad oil losses and subtracted that from his conservative estimate of the earning power of the real businesses. He concluded that the intrinsic value of American Express was, at a minimum, back at its pre-scandal level of around $60 per share. Yet the market was offering it to him for $35. With this conviction, born from rigorous, independent valuation, Buffett acted decisively. He invested 40% of his entire partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the market realized the scandal was a one-time event and the core business was a cash-generating machine, the stock price soared. Buffett's partnership made a fortune. He didn't time the market. He didn't predict the news. He simply calculated the value of a great business when it was on sale due to a temporary problem and bought it with an enormous margin of safety. The process of calculating intrinsic value is a powerful antidote to some of our most ingrained cognitive biases. When Buffett was investigating American Express, he was actively fighting against two powerful mental shortcuts: the availability heuristic and confirmation bias. The availability heuristic is our tendency to overestimate the likelihood of events that are more recent, more dramatic, and easier to recall. The salad oil scandal was the perfect fodder for this bias. It was a shocking, dramatic story that was on the front page of every newspaper. For most investors, this dramatic event completely overshadowed the boring, long-term reality of the company's powerful business model. Their brains fixated on the readily available image of fraud and financial ruin, making them believe it was more significant to the company's future than it actually was. Buffett, through his methodical research, deliberately sought out less available, but more important, information. He went looking for the quiet, everyday evidence of business as usual at restaurants and banks. He replaced the loud, available data of the scandal with the quiet, fundamental data of ongoing business strength. Secondly, he had to overcome confirmation bias, which is our natural tendency to search for, interpret, and favor information that confirms our pre-existing beliefs. An investor who thought Amex is doomed would only read the negative articles and focus on the potential liabilities. An investor who thought Amex is a great company might be tempted to use overly optimistic assumptions in their valuation. Buffett's approach is to act like a scientist testing a hypothesis. His initial hypothesis might have been, "I think Amex is cheap," but his research method was designed to try and disprove that hypothesis. He went out looking for evidence that the brand sport is damaged. By seeking disconfirming evidence, he could have more confidence in his final conclusion when he failed to find it. This disciplined, scientific approach to valuation is essential. It requires you to actively question your own assumptions and to fight the brain's natural desire for easy, confirming stories. The calculation of intrinsic value is not just a spreadsheet exercise. It is a process of intellectual honesty, designed to get as close to the objective truth as possible, free from the distortions of our own psychology. So how can one perform a practical, albeit simplified, calculation of intrinsic value without getting lost in complex financial modeling? One powerful mental model is what we can call the back-of-the-envelope DCF, with DCF standing for discounted cash flow. This is the core methodology Buffett uses, and you can apply its principles to your own thinking. Here is a simplified blueprint. Step 1. Find a stable, predictable business. This method doesn't work for speculative tech startups or companies with erratic earnings. It works best for businesses like Coca-Cola, Johnson & Johnson, or Waste Management, companies that have been producing consistent results for decades. Step 2. Find the owner earnings. This is the key number. A good proxy for this is the company's free cash flow, which you can find on financial websites. Free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. It's the cash that could be returned to shareholders. Look at the free cash flow per share for the last 10 years to get a feel for its consistency and growth. Step 3. Project the earnings forward. Take the current free cash flow per share and project it out for the next 10 years. The most important rule here is to be extremely conservative. If the company has grown at 8% per year for the last decade, don't assume it will continue to do so. Maybe project 4% or 5% growth. The future is uncertain, so your estimates must be conservative. This is a critical part of building in a margin of safety at the calculation stage itself. Step 4. Add a terminal value. After 10 years, the business will still be worth something. You need to estimate this. A simple way is to take the projected earnings in year 10 and assume the company will be sold for a conservative multiple, perhaps 10 to 15 times those earnings. This gives you a lump sum value at the end of your projection period. Step 5. Discount everything back to today. This is the crucial concept. $1 in 10 years is worth less than $1 today. You need to discount all those future cash flows, the 10 years of projections plus the terminal value, back to their present value. What discount rate should you use? A good starting point is the rate on a long-term government bond, plus a few percentage points to account for the additional risk of owning a stock. If the 10-year Treasury bond yields 4%, you might use a discount rate of 7% or 8%. When you sum up the present value of all those future cash flows, the number you get is your estimate of the company's intrinsic value per share. It's not a precise figure, but it gives you a ballpark estimate of worth. You now have a logical anchor, a number you can compare to the wildly fluctuating price offered by Mr. Market. The path of the 99% stands in stark contrast to this disciplined process of valuation. The vast majority of market participants do not calculate intrinsic value. They extrapolate narratives. This is the growth at any price fallacy. They become captivated by a compelling story about the future: artificial intelligence, electric vehicles, clean energy, a new miracle drug, and they pay any price to be a part of that story. Their decision to buy is not based on a conservative estimate of future cash flows discounted back to the present. It's based on the belief that the company will grow so fast for so long that any price paid today will eventually be justified. This is a seductive and extremely dangerous way to invest. Take the example of many popular technology stocks in recent years. Investors saw the incredible growth of a company like Nvidia or Tesla and simply assumed that this growth would continue at a high rate indefinitely. They would look at the stock price and, instead of comparing it to a calculated intrinsic value, they would compare it to the price it was a year ago. The rising price itself became the justification for buying. They were not buying a business at a sensible price. They were buying a story, a ticket on a rocket ship they hoped would never return to Earth. The problem is that reality always, eventually, intrudes. Hypergrowth is incredibly difficult to maintain. Competitors emerge, markets become saturated, execution stumbles. When the growth story begins to falter, even slightly, stocks bought on this premise can collapse. A stock that is priced for perfection will plummet on anything less than perfection. An investor who paid 100 times earnings for a company sees the stock fall by 50%, and they are left with a stock that is still trading at a rich valuation of 50 times earnings. They have no anchor of intrinsic value to hold on to. They don't know if it's now cheap or still expensive. They only know they have lost a lot of money. This is the fate of those who chase stories instead of calculating value. They are building their financial houses on the sand of a popular narrative, and when the tide of sentiment turns, the structure is washed away. The disciplined value investor, by contrast, builds their house on the bedrock of a conservative valuation, a foundation that can withstand the storms of market volatility. The direct financial connection of calculating intrinsic value lies in its ability to properly interpret and act upon common market metrics, most notably the price-to-earnings PE ratio. For many beginners, the PE ratio is the first and only valuation tool they learn. The rule of thumb is, low PE is cheap, high PE is expensive, but this is a dangerous oversimplification. The calculation of intrinsic value is what allows you to understand the asterisk quality of the E in the PE ratio, and therefore what P is actually justified. Imagine two companies, Company A and Company B. Both have earnings of $5 per share. Company A is a low-quality, cyclical manufacturing business with no competitive advantage. It trades at a PE ratio of 8, so its stock price is $40. Company B is a high-quality consumer brand with a powerful economic moat and a long history of consistent growth. It trades at a PE ratio of 20, so its stock price is $100. The beginner investor looking only at the PE ratio would conclude that Company A is the cheaper stock, the better investment. The intelligent investor, however, performs an intrinsic value calculation. For Company A, they project flat or erratic future earnings, reflecting its lack of a moat. They use a higher discount rate to account for the business risk. They might calculate an intrinsic value of only $45 per share. At a price of $40, it offers a very small margin of safety. For Company B, they project steady, reliable growth in earnings for decades to come, reflecting its strong brand. They can use a lower discount rate because the business is so predictable. Their calculation might yield an intrinsic value of $150 per share. At a price of $100, Company B offers a massive 33% margin of safety, $50 discount on a $150 value. The conclusion is the complete opposite of the beginners. The expensive stock with the high PE ratio is actually the far cheaper investment, offering substantially more value relative to its price. This is the financial power that a proper valuation gives you. It allows you to look beyond simplistic, surface-level metrics and understand the true relationship between the price you are paying and the long-term earning power you are receiving. It is the difference between price investing and value investing. Having established the difference between price and value, and having learned the importance of calculating that value, we now arrive at the core principle itself, demanding your margin of safety. This is the bridge between analysis and action. It is not enough to know what a business is worth. You must have the discipline to insist on buying it for significantly less. This discount is the buffer. It is the shock absorber that protects you from the unpredictable nature of the world. As Benjamin Graham wrote, the function of margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. You can be wrong about the precise growth rate. You can be wrong about a future recession. An unexpected competitor can emerge. Bad luck can strike. The margin of safety is your protection against all of these. It ensures that even if your analysis is slightly off, or if events don't unfold as you expected, you still have a high probability of not losing money, and a good probability of making a satisfactory return. It is the ultimate form of defensive investing. It is not about maximizing your potential gains on any single investment. It is about minimizing your potential for permanent loss across your entire portfolio. This principle transforms investing from a game of precision and prediction into a game of prudence and probability. And no investment in Warren Buffett's career demonstrates the sheer power of demanding an enormous margin of safety better than his purchase of the Washington Post Company during the depths of a brutal bear market. The year was 1973. The stock market was in the midst of a devastating crash. The Nifty 50 growth stocks, which had been darlings of the previous bull market, were collapsing. Investor sentiment was at rock bottom. Panic and despair were the prevailing emotions. It was in this environment of extreme fear that Warren Buffett saw an extraordinary opportunity. The Washington Post Company was not just any newspaper publisher. It was a media empire of the highest quality. It owned the dominant newspaper in the nation's capital, Newsweek magazine, and several highly profitable network-affiliated television stations. The company was run by the brilliant and formidable Katharine Graham. It had a deep and wide economic moat, a fortress-like competitive position. Buffett, having followed the company for years, had done the work. He had meticulously calculated its intrinsic value. He analyzed the cash flows from each of its properties. He understood the pricing power of its newspaper and the broadcast licenses of its TV stations, which were essentially government-granted monopolies. His conservative calculation of the company's private market value, what a knowledgeable buyer would pay for the whole enterprise, was at least $400 million, or about $80 per share. But in the carnage of the 1973-74 bear market, Wall Street was selling off everything. The Washington Post stock price, which had been as high as $38 just a year earlier, plummeted to below $6 per share. This meant the entire company, which Buffett knew was worth at least $400 million, had a market capitalization of just $80 million. He was being offered the chance to buy a dollar bill for 20 cents. This was not a small discount. This was not a 10% or 20% margin of safety. This was a colossal, once-in-a-generation margin of safety of nearly 90%. The gap between price and value was a chasm. So while other investors were panicking and selling, Buffett was calmly and aggressively buying. He invested over $10 million, accumulating a huge stake in the company for Berkshire Hathaway. He knew that the temporary market panic had absolutely no bearing on the long-term value of the Washington Post's incredible business franchise. He didn't know when the market would recover, but he didn't need to. His enormous margin of safety provided the patience. The investment became one of the most successful in Berkshire's history. That initial $10 million investment grew to be worth over $1 billion over the following decades, a 100-fold return. This legendary success was not due to a brilliant prediction. It was due to the simple, disciplined application of the margin of safety principle. Calculate what a great business is worth, and then wait, with the patience of a saint, for a terrified market to offer it to you at a fraction of that price. The margin of safety is more than just a financial concept. It is a powerful psychological tool that directly counteracts one of the most destructive biases in investing, loss aversion. Decades of research in behavioral economics, pioneered by Daniel Kahneman and Amos Tversky, have shown that for humans, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels as bad as winning $2,000 feels good. This asymmetry is wired into our brains. It's what makes us check our portfolios constantly when the market is down, feeling each tick lower as a physical blow. It's what causes investors to panic sell at the absolute bottom, just to make the pain stop. Loss aversion turns rational people into their own worst enemies. The margin of safety is the ultimate antidote to this self-destructive tendency. Let's revisit Buffett's purchase of the Washington Post. He bought it at around $6 per share, knowing it was worth at least $80. Imagine the stock then dropped further to $4 per share. For the average investor who bought at $6 without a concept of value, this 33% drop would be terrifying. Loss aversion would kick in, screaming, "Get out! You're losing money! It's going to zero!" But for Buffett, the mental calculus was entirely different. His anchor was not his purchase price of $6. His anchor was his calculated intrinsic value of $80. A drop from $6 to $4 didn't signal danger. It signaled an even greater opportunity. The dollar bill he was buying for 20 cents was now being offered for a nickel. Instead of panic, he would feel excitement. The margin of safety provides a psychological fortress. It reframes a market decline from a source of fear into a source of opportunity. Because your confidence is based on your own independent valuation, not on the market's current price, you are insulated from the emotional contagion of the crowd. When you know you have purchased a wonderful business at 50 cents on the dollar, a subsequent drop to 40 cents on the dollar does not induce panic. It makes you want to back up the truck. This is how the rich get richer. They use market downturns, fueled by the loss aversion of the masses, to acquire high-quality assets at bargain prices. The margin of safety is the intellectual framework that makes this rational, contrarian behavior possible. To make this principle practical, you need a framework for deciding how large your margin of safety should be. It's not always 50%. The size of the required discount depends on the quality and predictability of the business you are analyzing. We can call this the tiered margin of safety framework. It's a mental model for matching your required discount to the specific investment. Tier 1 is the fortress, which requires a 50% or greater margin of safety. This is the tier you use for the majority of investments. These are good, but not truly exceptional, businesses. They might be in cyclical industries like manufacturing or energy. They might have more competition. There might be more uncertainty about their long-term future. For these companies, because the business itself is less predictable, you need the valuation to provide an enormous buffer. You are buying a fair business, so you must demand a wonderful price. This is the classic Benjamin Graham approach, where the safety comes almost entirely from the discount. Tier 2 is the moat, which requires a more moderate 25% to 40% margin of safety. This tier is reserved for the truly wonderful businesses, the Coca-Colas, the See's Candies, the American Expresses of the world. These companies have deep and durable competitive advantages, or economic moats. They have predictable earnings, strong brands, and excellent management. Because the quality of the underlying business is so high and its future so much more certain, you can accept a smaller discount. Your safety comes from a combination of the business quality and the price you pay. As Charlie Munger has said, a great business at a fair price is superior to a fair business at a great price. This tier reflects that wisdom. Tier 3 is the uninvestable. For these companies, no margin of safety is large enough, because the intrinsic value is either zero or completely unknowable. This category includes speculative ventures with no history of earnings, companies in industries facing terminal decline with no other assets, or businesses that are simply too complex to understand. The 99% often gets drawn into this tier, hoping to strike it big. The intelligent investor recognizes that if you cannot conservatively estimate a company's intrinsic value, you cannot determine if there is a margin of safety. Therefore, you must pass. This tiered framework transforms the abstract concept of a margin of safety into an actionable decision-making tool. It forces you to be honest about the quality of the business you are analyzing and to demand a price that appropriately compensates you for the risks you are taking. The antithesis to this disciplined, tiered approach is the common but disastrous strategy of buying the dip without a compass. The 99% of investors hear the old adage, buy low, sell high, and they interpret it as a simple instruction to buy any stock that has recently fallen in price. They see a popular tech stock that was $300 a month ago now trading at $200, and they think, wow, it's on sale. It's 33% off. This is a catastrophic misapplication of the margin of safety principle. They are applying a discount to a previous Tara price Tara bean, not to a calculated Tara value. This is the equivalent of catching a falling knife. The fact that a stock has fallen does not in any way mean that it is cheap. The stock that fell from $300 to $200 might have an intrinsic value of only $50. In that case, buying at $200 isn't securing a margin of safety. It's locking in a near-certain path to further losses. During the dot-com bust, investors who bought the dip in companies like Cisco Systems found this out the hard way. Cisco fell from over $80 to $60, and they bought. Then it fell to $40, and they bought more. It eventually bottomed out below $15. At each stage, they thought they were getting a bargain because they were anchored to the old, bubble-era prices. They had no independent calculation of intrinsic value to guide them. The margin of safety investor does the opposite. Their process is to first calculate the value, completely independent of the price. Let's say they value a company at $100. They then set their buy price based on their required margin of safety, let's say 50% or $50. They then wait. They do not care if the price is $200 or $150 or $100. They only become interested when the price falls to their predetermined level of $50. Buying the dip is a reactive, price-focused action. Applying a margin of safety is a proactive, value-focused discipline. One is gambling that a trend will reverse. The other is investing on the basis of a known and significant discount to a calculated worth. The former is a recipe for disaster. The latter is the foundation of portfolio protection. The direct financial connection between demanding a margin of safety and your investment results can be seen in the volatility metrics of your portfolio, specifically its beta and standard deviation. Beta is a measure of a stock's or portfolio's volatility in relation to the overall market. A beta of 1 means the portfolio moves in line with the market. A beta greater than 1 means it's more volatile. A beta less than 1 means it's less volatile. A portfolio constructed exclusively of securities purchased with a significant margin of safety will, by its very nature, exhibit a much lower beta than the market. Why? Because the margin of safety acts as a valuation cushion. When a broad market panic ensues and the S&P 500 falls by 30%, the stocks in your portfolio are already cheap to begin with. While they may fall further, their downside is inherently limited because they are already trading at a discount to their liquidation or earning power value. They have less air in them to come out. The overvalued, high-flying glamour stocks are the ones that fall 50%, 70%, or even 90% because they were priced for perfection. Therefore, in a downturn, a margin of safety portfolio will fall significantly less than the overall market. This is not just a theoretical concept. It is the mathematical reality of wealth preservation. Let's consider two portfolios. Portfolio A is built by a momentum investor, filled with high beta tech stocks. Portfolio B is built by a value investor, filled with solid businesses bought at 50 cents on the dollar. A severe bear market hits, and the market drops 40%. Portfolio A, with its high beta, might drop 60%. Portfolio B, with its low beta margin of safety cushion, might only drop 20%. The difference in recovery is staggering. The investor with Portfolio B only needs a 25% gain to get back to even. The investor with Portfolio A needs a 150% gain just to recover their initial capital. The margin of safety isn't about avoiding all paper losses in a downturn. That's impossible. It is about systematically reducing the depth and severity of those losses, which dramatically shortens your recovery time and prevents the kind of catastrophic drawdowns that can permanently impair your ability to compound wealth. The true power of the margin of safety is not just defensive. It is the intellectual and emotional foundation that allows an investor to remain rational during periods of extreme market volatility. It is the ultimate antidote to the twin destroyers of wealth, fear and greed. In a bull market, when prices are rising and stories of overnight riches are everywhere, greed takes hold. The fear of missing out, or FOMO, becomes overwhelming. The margin of safety acts as a vital anchor to discipline. When a stock you own rises to or above your estimate of its intrinsic value, the margin of safety has disappeared. This provides a clear, logical signal to consider selling, no matter how popular the stock has become. It prevents you from riding a bubble all the way to the top and then all the way back down again, but its real value is revealed in a crisis. When the market is crashing, when headlines are screaming of financial apocalypse, fear becomes all-consuming. The primal instinct is to sell everything, to run for the hills. This is when the margin of safety gives you the courage to act. It transforms you from a participant in the panic to an opportunist. It provides the intellectual conviction to buy when everyone else is selling, to be greedy when others are fearful. And there is no greater example of this principle in action than Warren Buffett's conduct during the darkest days of the 2008 global financial crisis. In the autumn of 2008, the global financial system was on the brink of collapse. Lehman Brothers had filed for bankruptcy, AIG had been bailed out. The credit markets were frozen solid, and fear was at a level not seen since the Great Depression. The stock market was in a freefall. It felt like the end of the world. For most investors, the only thought was self-preservation, which meant selling assets at any price. But for Warren Buffett, this was the moment he had been preparing for his entire life. With Berkshire Hathaway's fortress-like balance sheet, he was one of the few individuals with both the capital and the psychological fortitude to act. The phone in his Omaha office began to ring. First, it was Goldman Sachs, one of the most prestigious investment banks in the world. They were desperate for capital to shore up their balance sheet and restore confidence. They weren't just looking for a loan. They needed a stamp of approval from the world's most trusted investor. Buffett negotiated a deal that was legendary in its brilliance, made possible only by the extreme fear in the market. Berkshire invested $5 billion in Goldman Sachs preferred stock that paid a juicy 10% annual dividend. But that wasn't all. He also received warrants, giving him the right to buy $5 billion worth of Goldman's common stock at a fixed price for the next 5 years. He was being paid handsomely to wait, and he got a massive free option on the upside. A few weeks later, he made a similar deal with General Electric. Then, in 2011, with the European sovereign debt crisis still rattling markets, he made a $5 billion investment in Bank of America on similarly favorable terms. How was he able to do this? How could he calmly deploy billions of dollars when the entire world believed the financial system was imploding? The answer is the margin of safety. He wasn't betting on a stock price. He was analyzing the long-term, normalized earning power of these essential financial institutions. He calculated what they would be worth once the storm passed. The prices he was offered in the depths of the crisis represented a massive discount to that long-term value. Furthermore, the structure of his deals, with preferred stock and high dividends, provided an additional margin of safety. He was first in line to get paid. He was acting not out of bravery but out of a cold, rational calculation of risk and reward. The panic in the market provided him the price he required. His analysis of intrinsic value gave him the confidence to act. This is the margin of safety in its purest form, an intellectual framework that conquers the most powerful and destructive human emotions. The psychological force that Buffett overcame in 2008 is one of the most powerful in human nature. Herd behavior, also known as the instinct for social proof. As social creatures, we are wired to find safety in numbers. For millennia, this was a survival trait. If everyone in your tribe suddenly started running, it was not wise to stand around and investigate why. It was wise to run with them. This instinct is still deeply embedded in our brains, And in the stock market, it is financially lethal. When the market is soaring and our friends and neighbors are bragging about their profits, the pressure to join the herd and buy becomes almost unbearable. This is the social proof of greed. Conversely, when the market is crashing and the news is filled with stories of financial ruin, the instinct to sell with the herd is just as powerful. This is the social proof of fear. The margin of safety is a powerful psychological circuit breaker against herd behavior. It provides an independent, internal source of validation that is more powerful than the external validation of the crowd. Your decision to buy is not based on the fact that others are buying. It is based on a specific, quantitative relationship between price and your calculated value. Your decision to sell is not based on the fact that others are selling. It is based on the disappearance of that same margin of safety. It creates what Buffett calls an inner scorecard. An investor with an outer scorecard judges their success by whether their actions are in line with the crowd or with recent market performance. They feel smart when a stock they buy goes up and dumb when it goes down. An investor with an inner scorecard judges their success by whether they adhere to their own disciplined process and sound intellectual framework. Did I calculate intrinsic value conservatively? Did I insist on an adequate margin of safety? If the answer is yes, then the decision was a success, regardless of the stock's short-term price movement. Developing this inner scorecard, with the margin of safety at its core, is the key to achieving the emotional detachment necessary for long-term investing success. It allows you to buy from the panicking herd at the bottom and sell to the euphoric herd at the top. To operationalize this emotional discipline, you can use a powerful mental model that I call the Investor's Creed exercise. This is a pre-commitment device, a way of formalizing your logic before chaotic emotions of fear and greed enter the picture. It's a simple, written contract with yourself. Here's how to create it for every investment you consider. First, on a clean sheet of paper or a blank document, you write down your full investment thesis. You must clearly and simply state why you are buying this business. It's not enough to say it's a good company. You must be specific. Second, you must quantify your valuation. Write down the sentence, I believe company X is worth approximately $Y per share, based on my conservative calculation of its future earning power, for the following key reasons, A, B, and C. This forces you to put a number on your valuation and to justify it. Third, you explicitly define your margin of safety. Write the sentence, therefore I will only consider purchasing this stock at or below the price of $Z. Price Z is, of course, your calculated value Y minus your required margin of safety. This sets a hard, non-negotiable buy-in price. Fourth, you create a plan for future volatility. Write down, if, after my purchase, the price falls significantly further below $Z and my fundamental reasons A, B, and C for owning the business remain fully intact, I will view this as a positive development and an opportunity to purchase more at an even greater discount. This frames future price drops as opportunities, not threats. Finally, you sign and date the document. This simple act of formalization has a profound psychological impact. You have now created a logical, unemotional record of your decision-making process. When the market goes crazy and your emotional brain starts to panic or get greedy, you can pull out this document. It is your anchor to rationality. It reminds you of the careful work you did when you were calm and clear-headed. It is your creed, your personal investment constitution, and it is your single best defense against the emotional roller coaster that derails the 99%. The path of the 99% is the polar opposite of this disciplined, pre-committed approach. They are on a perpetual emotional roller coaster, with their portfolio as the passenger. Their journey begins not with analysis, but with a tip or a story. They hear about a hot stock on the news or from a friend at a barbecue. Greed and FOMO kick in. There's no valuation, no margin of safety, just a desire to get in on the action. So they buy. For a while, the stock may go up, reinforcing their decision and giving them a false sense of genius. This is the euphoric peak of the roller coaster. Then, the market turns. The story changes, or a bad earnings report comes out. The stock begins to fall. Since they have no anchor of intrinsic value, their only reference point is their purchase price. The stock drops 10%, then 20%. Loss aversion starts to take hold. The pleasure of their earlier gains is quickly erased by the sharp pain of their current paper losses. The question that haunts them is, what should I do? They have no framework to answer it. They didn't have a reason to buy it at a specific price, so they have no reason to hold it or sell it at the new, lower price. Fear escalates into panic. They imagine the stock going to zero. Unable to bear the psychological pain any longer, they sell, often near the bottom, locking in a permanent loss of capital. This is the terrifying plunge of the roller coaster. Then, inevitably, the market recovers. The company's temporary problems are resolved. The stock they sold begins to climb again, eventually surpassing the price they paid for it. Now they are whipsawed by regret and frustration. This painful cycle repeats, over and over, with different stocks in different market environments. They are not investing, they are simply reacting. They are puppets, and the strings are being pulled by the market's manic depressive moods and their own untamed emotions. The margin of safety is what cuts those strings forever. The direct financial impact of using the margin of safety to conquer fear and greed is best understood through the concepts of drawdowns and time to recovery. A drawdown is the peak-to-trough decline of your portfolio's value. The single most important mathematical reality for any long-term investor is that the severity of your drawdowns has an asymmetrical and devastating impact on your long-term returns. The math is brutal. If your portfolio falls by 10%, you need an 11% gain to get back to even. Manageable. If your portfolio falls by 25%, you need a 33% gain to recover. Difficult, but possible. But if your portfolio suffers a 50% drawdown, as many investors did in 2000 and 2008, you need a 100% gain, a full doubling of your remaining capital, just to get back to where you started. That can take years, even a decade, of lost time and lost compounding. The margin of safety is a system designed, above all else, to minimize the depth of your maximum drawdown. By avoiding the purchase of overvalued securities, you are systematically removing the investments most likely to suffer catastrophic declines. By buying good businesses at a significant discount, you are building a portfolio that has a natural cushion. In a market crash, your portfolio might still experience a 20% drawdown. That's unpleasant, but recoverable. It only requires a 25% gain to get back to even. Your neighbor, who was chasing the hot stocks of the bubble, suffers a 60% drawdown. He needs a 150% gain to recover. While he spends the next decade just trying to get his head back above water, your capital has already recovered and is back to the powerful work of compounding. This is the hidden arithmetic of wealth preservation. The person who wins the race is not always the one who runs fastest in the good years, but the one who avoids the big stumbles in the bad years. The margin of safety is your financial shock absorber. It smooths the ride, protects your capital base, and ensures that the inexorable engine of compounding can continue to work its magic over a lifetime. We have now come to the final and perhaps most profound pillar of this philosophy. The margin of safety is not merely a defensive tactic for avoiding losses. It is the foundational element that enables the most powerful force in the financial universe, long-term compounding. By successfully adhering to Buffett's first two rules, never lose money, and never forget rule number 1, you are protecting your capital base. An intact capital base is the seed from which a great financial oak can grow. Every major loss is like chopping down the sapling and having to start again from a new seed. By avoiding those losses, you allow the tree to grow, year after year, decade after decade, until its growth becomes an unstoppable force. The margin of safety, therefore, is not just about wealth preservation, it is the essential fuel for long-term wealth creation. It ensures you stay in the game long enough for the miracle of compounding to work for you. And the investment that perhaps taught Buffett this lesson most profoundly was not a dirt-cheap cigar butt, but a wonderful business that he and Charlie Munger purchased in 1972, See's Candies. By the early 1970s, Buffett was evolving beyond the pure, quantitative cigar butt investing of his mentor, Benjamin Graham. Influenced heavily by his partner, Charlie Munger, he began to understand that the greatest margin of safety could come not just from the price you pay, but from the quality of the business you buy. The opportunity to purchase See's Candies, a beloved West Coast manufacturer of boxed chocolates, presented the perfect test case for this new thinking. See's was a fantastic business. It had a cherished brand, incredible customer loyalty, and, most importantly, pricing power. The company could raise its prices year after year to cover inflation and increase its profits, and its loyal customers would happily pay. Buffett and Munger purchased See's for $25 million. By traditional Graham metrics, it wasn't spectacularly cheap. They paid a fair price for the business, which was a significant premium to its tangible assets. So where was the margin of safety? It was in the durable competitive advantage, the economic moat of the business itself. The safety came from the high probability that See's would continue to be a wonderful, cash-gushing business for decades to come. The purchase proved to be a masterstroke. See's Candies became the prototype for the kind of business Berkshire Hathaway would seek to own. It required very little additional capital investment to grow. It just produced more and more cash, year after year. That initial $25 million investment has since returned over $2 billion in pre-tax earnings to Berkshire Hathaway, cash that Buffett could then redeploy into other wonderful businesses purchased with a margin of safety. See's taught Buffett that avoiding losers by demanding a margin of safety on price was only half the equation. The other half was to buy winners, businesses with a margin of safety in their operations, and then hold on to them, letting them compound their value over time. By not losing money on bad businesses and by allowing the great businesses to work their magic, the margin of safety becomes the bedrock upon which a compounding machine is built. It protects your capital in the short term so that the power of compound growth can make you truly wealthy in the long term. The patient, long-term approach required to let a business like See's Candies compound its value runs directly contrary to another powerful psychological bias, hyperbolic discounting, also known as present bias. This is our brain's strong preference for a smaller, immediate reward over a much larger reward in the future. It's why people choose to eat a donut today, rather than reap the long-term benefits of a healthy diet. It's why they'll take a small payout now, rather than wait for a much larger one later. In investing, this bias manifests as an obsession with short-term performance and a constant search for get-rich-quick schemes. The mathematical reality of compounding is that it is heavily back-end loaded. The real, eye-popping gains come in the later years. But our present biased brains struggle to appreciate this. We want the reward now. The entire philosophy of value investing, anchored by the margin of safety, is an exercise in overcoming hyperbolic discounting. The process itself forces delayed gratification. You must patiently conduct your research. You must patiently wait, sometimes for years, for your target company to reach your buy price. Then, after you buy, you must patiently hold it for decades, resisting the urge to sell and lock in a small, immediate profit. This is not natural. It requires conscious discipline. The margin of safety aids this discipline by giving you the confidence to wait. Because you bought at such a great price, you feel no pressure to sell for a quick gain. You are happy to be a long-term owner, knowing that your downside is protected. It aligns your behavior with the long-term realities of compounding. It helps you resist the siren song of the immediate reward, and instead allows you to harvest the truly life-changing rewards that only come to those who can wait. It is a system for forcing your actions to be rational in the long term, despite your brain's irrational preference for the short term. To put this long-term compounding mindset into practice, you can adopt what Buffett calls the punch card or permanent portfolio mental model. It's a framework for ensuring extreme selectivity and a long-term orientation. Here is the blueprint. Step 1. Imagine that you have a punch card with only 20 punches on it. These 20 punches represent every investment you are allowed to make in your entire lifetime. Once you've used all 20, you can't make any more. This simple mental constraint has a profound effect. It immediately eliminates casual, impulsive speculation. Every single investment decision becomes momentous. You are forced to wait for the absolute best opportunities, the true fat pitches. Step 2. For each punch on your card, you must find an opportunity that meets your strictest, most conservative criteria for both intrinsic value and margin of safety. You're not looking for something that is pretty good. You're looking for a no-brainer. You are seeking to fill your 20 slots with a collection of the highest quality businesses you can find, bought at the most advantageous prices possible. Step 3. Once you punch your card and make an investment, your default holding period is forever. You are not a trader. You are a permanent part owner of a business. The only reasons to ever sell, to unpunch the card so to speak, are if you realize your initial analysis was critically flawed, if the fundamental long-term economics of the business have deteriorated, or, very rarely, if you find a new opportunity that is so dramatically superior to your current holding that it justifies the switch and the taxes incurred. Step 4. You diligently reinvest all dividends received from your portfolio companies. This creates a closed-loop compounding machine. Your carefully selected high-quality businesses generate cash, which is then used to, eventually, punch the next hole in your card when another extraordinary opportunity presents itself. This model forces the discipline that is the hallmark of all great investors. It fosters patience, selectivity, and a true long-term owner's mindset, which are the essential ingredients for harnessing the full power of compound growth. The path of the 99% is, once again, the complete opposite. It is the churn and burn approach. Most market participants are not investors. They are hyperactive traders. Their time horizon is not years or decades, but days or weeks. They are constantly looking for what's hot now, chasing the latest trend or story. They buy a stock, and if it goes up 15% in 2 months, they sell to lock in a profit. They feel smart, but they have made a critical error. They have sold a flower to go look for more weeds. By selling their winners early, they constantly interrupt the process of compounding. They never give a great business the time it needs to truly multiply its value. Compounding needs an uninterrupted runway to take off, and they are constantly bulldozing the runway to build a new one. This hyperactivity also racks up enormous costs that erode returns over time. Every trade incurs transaction costs. Every short-term gain is taxed at a higher rate than long-term gains. This constant friction is like trying to run a race while wading through wet cement. Worst of all, this approach often leads to a portfolio where the investor sells their winners and holds onto their losers, hoping they will come back. This is the exact opposite of what you should do. The result is a portfolio that becomes a garden full of weeds, having pulled all the flowers. The churn and burn approach is a direct consequence of a short-term, present-biased mindset, unmoored from the discipline of the margin of safety. It is a frantic, expensive, and ultimately futile attempt to outsmart the market, when the real secret to wealth is to simply buy wonderful businesses at a fair price and let them do the hard work for you over a very long period of time. The direct financial connection that links the margin of safety to long-term compounding is the mathematical relationship between a company's return on invested capital, ROIC, and the growth of its intrinsic value. ROIC is a measure of how efficiently a company uses its capital to generate profits. A business that can consistently generate a high ROIC, say 15% or more, is a powerful compounding machine. For every dollar it retains and reinvests in its operations, it generates 15 cents of new annual profit. The intrinsic value of such a business will compound at a rate that closely approximates its ROIC over the long term. This is where the margin of safety delivers a powerful 1-2 punch. First, the entire process of value investing naturally steers you toward businesses with high and stable ROIC. because these are the businesses with the predictable earnings and economic moats that make a reliable intrinsic value calculation possible. You are fishing in the right pond. Second, by insisting on buying this high ROIC business at a significant discount, you supercharge your own personal rate of return. Let's say you identify a fantastic business with a sustainable 15% ROIC. You calculate its intrinsic value to be $100 per share. You patiently wait and buy it during a market panic for $50 per share, a 50% margin of safety. The business's intrinsic value will likely grow at around 15% per year, but your personal return will be even higher. Not only do you get that 15% underlying growth, but you also get the additional return from the price, eventually closing the gap with the value. The combination of buying an excellent business, high ROIC, at an excellent price, high margin of safety, is what generates the 20%, 25%, or even higher annualized returns that build legendary fortunes. You get paid twice, once by the quality of the business and once by the foolishness of the market. This is the ultimate financial engine. It is how the margin of safety transitions from a tool for merely preserving wealth to the single most effective tool for creating it over the long term. You have made a significant investment of your time, and in return you have acquired one of the most powerful mental models in the world of finance. The margin of safety is not just a rule of thumb, it is a complete philosophical system for interacting with an uncertain world. It is the intellectual fortress that separates the calm, rational investor from the frantic, emotional speculator. It gives you a method for valuing a business, a discipline for buying it at a discount, and the psychological fortitude to act when others are paralyzed by fear or blinded by greed. This framework, this way of thinking, is now a part of your mental toolkit. You are equipped to protect your capital and navigate the inherent volatility of the market with confidence. But a fortress, no matter how strong, is only one part of a kingdom. The margin of safety is the principle that tells you treat to strike when the price is right. But it is interconnected with another, equally powerful principle that tells you what to buy, what kind of business is worth owning in the first place. This is the concept of the economic moat, the durable competitive advantage that protects a company from competition, just as a moat protects a castle. Understanding how to identify these moats is the other half of the value investing equation. The margin of safety protects you from valuation risk, but an economic moat protects you from business risk. Together, they form an almost unbeatable combination. The journey to becoming a truly intelligent investor is a process of assembling these interconnected mental models. You have just forged the shield. The next logical piece of the puzzle, the next stop on your map, is to learn how to identify the sword. The video that is now appearing on your screen has been selected because it delves into this very concept. It is the missing link that connects the price you pay with the quality of the business you are getting. It is the next layer of the intellectual armor you are building. The choice to click is not about watching another video. It is a decision about your own identity. Are you a passive spectator? Or are you a dedicated student of this craft? Are you content with a single tool, or do you intend to build the complete arsenal? If you are committed to continuing your ascent, to completing the framework that allows for true financial freedom, then the path forward is clear. The next piece of the map is waiting for you. Click and continue the journey.